Welcome back to our channel, Traders and Investors. Today we're diving deep into two popular options trading strategies, covered calls and put options. Have you ever wondered about the difference between covered calls and put options? Stock options are a powerful tool that can help you manage risk and generate income in the stock market. But with so many different strategies out there, it can be tough to know where to start. When it comes to deciding between covered calls and put options, investors are often faced with a dilemma. On the one hand, you want to generate income and limit your risk. On the other hand, you don't want to give up too much upside potential. It's a delicate balance between risk and reward, and it's not always easy to know which way to lean. By the end of this video, you'll have a clearer understanding of these strategies, their differences, and how to determine which one might be right for you. So let's get started. First, let's talk about covered calls. A covered call is an option strategy where you own the underlying stock and sell a call option on that stock. This strategy is typically used by investors looking to generate additional income from their stock holdings. In a covered call, you hold a stock that you believe will not move significantly in the short term. You sell a call option at a strike price higher than the current market price. If the stock stays below the strike price, you keep the premium from selling the call option. If it goes above the strike price, you sell the stock at the strike price and keep the premium. Covered calls can be a great way to generate income, but they do cap your potential gains. If the stock price skyrockets, you'll miss out on those extra profits because you have to sell at the strike price. Now let's discuss put options. A put option gives you the right, but not the obligation, to sell a stock at a specified price before the option expires. This strategy is often used as a form of insurance or to speculate on the decline of a stock's price. When you buy a put option, you pay a premium for the right to sell a stock at the strike price. If the stock's price falls below the strike price, you can sell the stock at the higher strike price, potentially making a profit. If the stock's price stays above the strike price, the option expires worthless, and you only lose the premium paid. Put options can be a powerful tool for hedging against losses in your portfolio or for profiting from a stock's decline. However, they do come with the risk of losing the premium paid if the stock doesn't move as anticipated. Now that we understand the basics of each strategy, let's look at the key differences between covered calls and put options. With covered calls, you own the underlying stock. You can generate income from premiums. Covered calls have limited profit potential if the stock rises significantly. Covered calls are ideal for neutral to slightly bullish outlooks. With put options, there is no need to own the underlying stock. It can be used to hedge against losses or speculate on a decline. It has the potential for significant profit if the stock falls. Are ideal and best used for bearish outlooks or portfolio protection. When it comes to the key differences between covered calls and put options, it really comes down to profit potential, risk exposure, and the market outlook required for each strategy to be successful. Covered calls are typically used in neutral to bullish markets, where you're expecting the stock price to stay flat or rise. Put options, on the other hand, are often used in bearish markets, where you're expecting the stock price to fall. In terms of profit potential, covered calls are generally more conservative, with lower profit potential but lower risk. Put options, on the other hand, have higher profit potential but also higher risk. You have to be careful when using put options, because if the stock price takes off, your losses could be significant. So, which strategy is right for you? It depends on your financial goals and market outlook. If you're looking to generate additional income from stocks you already own and believe those stocks won't see significant price changes, covered calls could be a great fit. On the other hand, if you're concerned about potential declines in your portfolio or want to speculate on a stock's decline, put options might be the way to go. In the end, the choice between covered calls and put options depends on your individual risk tolerance and market outlook. Both strategies have their pros and cons, and it's up to you to decide which one is right for you. Thank you for watching this video. If you found this video helpful, please give it a thumbs up and subscribe to our channel for more tips and strategies on stock options trading and investing. Don't forget to hit the bell icon so you never miss an update. And if you have any questions or topics you'd like us to cover, drop a comment below.